one gear, overdrive.
I am X on an 86.25.
In 13 years, he drove Magellan to a 2,800% gain.
$20 million to $14 billion at the time of his retirement.
Do you look back and say, oh, I stopped too early? Whatever happened to Peter Lynch, right, is my question.
Peter Lynch is an investing legend. He has one of the greatest track records of all time, generating almost 30% per year during his time as a fund manager. And he did it by doing the exact opposite to everyone else on Wall Street. Betting on what are some of today's biggest household names, he was making so much money so quickly that he coined the term 10-bagger. Stocks he identified with the potential to skyrocket in price.
And your great mistakes is selling a good company, and it doubles, then it triples, and it quadruples, because you make a lot of mistakes, and so it's ones that go up tenfold, I call them the 10 baggers.
And the best part is that the edge, the advantage, is with you, the consumer.
This person didn't have a Cray computer, and he wasn't a professional investor. He was just an observant neighbor.
Giving us the opportunity to get one up on Wall Street.
He decided to put $2,000 per year into TAM brands. By 1972, the fireman was a millionaire.
A quick shout out to Shortform for sponsoring the video. Their super in-depth book summaries are my favorite way to learn the best ideas fast. They have summaries on Peter Lynch's books, including One Up on Wall Street and Beating the Street, or browse their huge and growing library across many genres. Don't miss out on a free trial and a 20% discount off your subscription by heading to shortform.com/Hamish.
For 13 years, I managed Fidelity Magellan Fund. Those were 13 amazing years.
If you had invested $10,000 with Peter Lynch when he took over the Magellan Fund in 1977 and held onto it until he quit in 1990, you would have been sitting on almost $300,000. But what if I told you that despite the incredible performance, many of Peter Lynch's clients actually lost money under him? According to Fidelity Investments, the firm which Peter Lynch worked for, the impressive returns didn't stop many investors in the Magellan Fund from losing money. This is possible because investors in the fund had the ability to withdraw or deposit their money frequently, and because Lynch's performance wasn't a straight line up.
On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9.
And some of these market declines were significant. In late 1980, the US stock market fell 24% over nearly 2 years. In 1983, the market fell 11% in just a year. And the biggest, of course, was the 1987 flash crash, a 30+% decline within a couple of months.
I got letters to when the market went down in 87, my fund went down like a rock.
Yeah.
People were writing letters to me cheering me up.
Some investors withdrew their money when the market was down out of fear of losing more. And they compounded their mistakes by investing more money while Lynch was experiencing strong short-term performance.
The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks. This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years.
The stock market is volatile and unpredictable in the short term, so you have to have a long-term perspective if you're going to have any success.
All you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know.
Keeping your emotions out of investment decisions is crucial. In fact, it's the inability of most people to do this as to why most people probably shouldn't own individual stocks. But if you can keep a calm temperament, you actually have a very significant advantage simply by not being in the finance industry.
Back in the 1950s, a fireman from New England noticed a factory in his town seemed to be hiring and expanding all of the time.
The company was Tampax, a feminine hygiene brand. Today, they're owned by Procter & Gamble, but in the 50s, it was its own listed stock.
He decided to put $2,000 per year into TAM brands, then called Tampax. By 1972, the fireman was a millionaire, just from using his local edge.
Peter Lynch believes that almost anybody can do well in the stock market as long as they focus on the industries where they have an edge.
But you have better stock picking skills than you realize. And you have advantages that no one on Wall Street has.
So in your own industry, you're going to see a lot of stocks, and that's what bothers me. Let's say you're an auto dealer the last 10 years. You would have seen Chrysler come up with a minivan. You could have made 10 times your money on Chrysler a year after the minivan came out.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. you've got it.
While the rest of the traditional finance industries had their heads buried in quarterly earnings reports and balance sheets, Lynch understood that the very best young companies could be found by starting with a qualitative consumer perspective, an approach that led him to one of his first very successful investments at Magellan. When trying out some of the coffee chains popping up around Boston, he realized he was overly impressed with one in particular, Dunkin' Donuts. The stores in his area were always full with lines out the door. He knew that Dunkin' had created something that customers loved, and that simple consumer perspective led him to eventually buy the stock.
I owned Dunkin' Donuts for 12 years. I think I might have talked to him once every year. The story didn't change a lot.
I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts.
Of course, before investing in Dunkin', Lynch did his deep research on the industry, he analysed the financial statements, and he had to calculate whether the stock was actually cheap on a cash flow basis. But Dunkin' turned out to be a home run pick, and it only appeared on his radar because of his personal, anecdotal, consumer perspective. The success story of this investment is also credited to another one of Lynch's investment principles: focus on simple, easy to understand businesses with a good story behind it.
A story is what's happening inside a company and signs that point to what's likely to happen in the future. A good story is one that you could tell a fifth grader, and he or she would understand. The more complicated the story, the more likely it is to fall apart.
As counterintuitive as it might seem at first, it's often the simplest ideas that have the best chance of success. We live in an increasingly complex world, and so there are very large companies that do not operate in the world of simple ideas. But many of the longest standing companies, brands, and products are simple and well executed. Your approach as an investor should be the same. Find simple companies that you can develop a deep understanding of.
And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
When he took over the Magellan Fund in 1977, Lynch had the green light from Fidelity to allocate capital in whichever and however many stocks he wanted. The portfolio had around 60 stocks in it at the time, but Lynch quickly increased this to a few hundred. But one of the most interesting stocks he won big on came well before his time as a fund manager. Peter Lynch was born on the 19th of January 1944 in Newton, Massachusetts.
I went to public schools, and we have the best colleges and universities in the world. No one would doubt that.
Right.
But K through 12 were not that hot.
After high school, he attended Boston College to earn his bachelor's degree. And in his second year, he bought his first stock in a company called Flying Tiger Airlines. It was the first scheduled cargo airline in the US, becoming one of the first carriers to do aerial pallet shipping around the time Lynch made his first investment. He bought 100 shares of the stock at around $7 per share. And as he finished his bachelor's degree, the stock rose to $80 per share, which helped pay for some of his education. After graduating in 1965, he attended Wharton for his MBA. In his spare time, he was a golf caddy at Braeburn Country Club, and one of the bags he was lugging around was that of D. George Sullivan, the then president of Fidelity Investments. As he finished his MBA, he was hired as an intern at Fidelity, covering the paper, chemical, and publishing industries. After a 2-year stint in the army, he was hired as a full-time researcher. His impressive work on the textiles, metals, mining, and chemical industries led him to become the director of research at Fidelity from 74 to 77 when he took over the Magellan Fund. And again, just like Dunkin' Donuts, Lynch was letting his consumer experience guide his investment decisions.
We bought a Volvo. It was better than the American station wagons. It was safer. The price was right. I did a little bit of research. I found that Volvo, the stock, it's a Swedish company, was selling equal to its cash.
One of the most important parts of investing is figuring out the right price to pay for a stock. Lynch came up with a simple ratio to figure it out. the PEG ratio. You take the price of the stock and divide it by the earnings or profits, then divide it by the expected annual growth rate. If the ratio was less than 1, then the stock was cheap, and if it was higher, it was expensive. In the case of Volvo, Lynch was buying a company that was doing well and the price was equal to the cash it had in the bank, meaning he was essentially investing in the company for free.
You're paying almost nothing for the company. They had lots of other divisions that were doing terrific. Buying that car turned out to be a great way to begin researching the stock.
Lynch's style of investing is what's known as GARP, growth at a reasonable price. It's a mixed approach between the growth and traditional value strategies. Instead of buying a crappy company at dirt cheap prices or a fast growing company at a premium, you're trying to get a mix of both.
Walmart went public in October of 1970. If you bought it when they went public, you would have made 500 times your money.
Buying Walmart stock as soon as it went public would have been following a traditional growth strategy. You're investing in an unproven business with great growth potential and paying a premium for it. And sure, in hindsight, you did incredibly well if you bought Walmart when it went public, but you also were taking a significant risk. Most freshly public companies don't turn into a Walmart. But even if you waited until the business was bigger, safer, and had a better story behind it, you still would have done really well.
You could buy Walmart 10 years after Walmart went public. Let's say you're a very careful investor. You waited. You said, I don't know if this company can make it. You waited for Walmart to roll it out. You could buy Walmart 10 years after they went public and made 30 times your money.
Walmart was already a huge success, but it only operated across about 15% of America. So your bet was that this proven business would continue to find success in other parts of the country.
And you can just watch it. You have plenty of time. People are in an amazing rush to purchase the security. They're out of breath when they call up.
With Peter Lynch, there was a huge emphasis on finding companies with a track record and still the potential to grow profits over the coming decades.
McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold.
Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold.
By 1990, Peter Lynch's near 30% annual return had made the Magellan Fund the best performing mutual fund over a 20-year period in history. But instead of continuing, at the age of 46, he decided to step away.
My father died at 46. So
And was that the reason 46? Or
I guess you 6 you might. He took sick when he was 43, died at 46. Maybe I was going to live to 146, but I said, I love the job, love the company, but I worked every Saturday for 11 years. I just want to spend more time with my wife and family.
Now he focuses his attention on philanthropy. He wrote multiple books on investing for the average person, and he pops up from time to time for the occasional interview.
And I think stocks over the next 10 years will do a lot better than 4.7 or 1.7. So I would have some of my money. Now it's up to the person to decide how much they want to have in the stock market. For some people, 10% is aggressive. For some people, 50% is the right amount. It's a personal decision. And you can't go by these rules that if you're 25, you should be 100%, and if you're 45, you should be 50%, and if you're 60, you should be 0, and I guess burping a lot. I don't know what the rules are on people at 60, but I hate those rules. I think they're pathetic.
It would mean a lot to me if you could hit the subscribe button. That way YouTube will remind you every once in a while that I still exist, and consider checking out one of these videos next.